Today we're launching a new model portfolio called Ramin's Global Winners. Now the idea behind this is that firstly it's going to educate you about markets like all of our content, but also it'll let you keep abreast of what's going on. And we're going to be looking across 5 different groups of exchange traded funds. So that'll be countries, but also US sectors, US factors, commodities and bonds. And so you'll have an overview of all of those different markets. Now we'll be publishing this on the 3rd Thursday of every month, so you can keep track of it, and it'll be published on stockcard.io, who's also sponsoring this video. So let's look at the inaugural portfolio in a bit more detail. Let's start by looking at the funds which we'll consider for the portfolio. Now these are all exchange traded funds and they're all traded in dollars. So there are 5 groups of funds. The first one, which is the largest, are the countries, and we have 44 countries that we consider. The second group are factors, which are US based. So these are 18 funds where we look at things like momentum, but also value, small cap value, all those factors. The third group is sectors, where we look at individual US sectors, things like tech, things like energy. The fourth group is commodities, and here there are just 8 funds. There's less to choose from here. And then the final group is bonds. So we look at different groups of bonds. Some of them are US Treasury funds with different durations, but we also have things like corporate bonds, investment grade and junk bonds, but also EM sovereign bonds, hard currency and local currency, and finally convertible bonds. Each month, we have to choose just one fund from each of those groups. And the way we do that is to look at momentum. Now we have to choose one winner from each of these 5 groups. So what we do is we look at the risk-adjusted momentum. We take the return over some period and we divide it by the volatility over that period. So funds which actually trend strongly upwards with not much volatility are the ones which are most likely to get through to the final round, where we put them into the portfolio. Now we've backtested this portfolio, so let's look at the historical return and risk that we'd have got given our current implementation. So the red line here is the return on our global winners portfolio, assuming we'd have invested $100 at the beginning of 2004, which is when the time series start for the funds which we've got available. And the blue line is the return on the S&P. So over that period, you can see that it has beaten the S&P, but most of the outperformance came early on, in particular by suffering a smaller drawdown during the global financial crisis. So if I were to characterize this, I'd say it's certainly a cautious portfolio. However, our goal here is not to underperform the S&P. In fact, we're trying to outperform. And when I was optimizing the portfolio, the metric I used was the number of months where the portfolio beat the S&P, which over this backtest period was about 56% of the time. So what I was adjusting here was the look back period. If you're calculating momentum over a short period, you'll be continually changing the weight and churning all the time, which isn't necessarily good. But if you look back over a longer period, you've got more stable weights, but your portfolio is less reactive to momentum. So if there is a turnaround, it can catch out the portfolio and you'll underperform. So that's the trade-off. Too short, you churn too much. Too long, and you're not responsive. If we compare the drawdown statistics, that's how much the portfolio has fallen since its previous all-time high. You can see that for the Global Winners portfolio, the worst drawdown was in 2008, when there was a drawdown of about 30%. And that compares quite favorably with the S&P, which lost over 50% over the same period. But the portfolio is certainly not perfect. You can see there was a kind of second dip here, which also happened for the S&P, but at least it wasn't as deep as it was for the S&P. Now that we've seen how the portfolio is constructed, let's look at the initial weights for this month. And let's start off by looking at the country funds. Now the backtest showed that the optimal look-back period for countries was quite short. It was 143 days. Now those are trading days, not calendar days. And the number you can see on this bar plot is the risk-adjusted momentum. In other words, it's the return over that 143-day period up to yesterday's close, divided by the volatility over the same period. Now the country fund which is outperformed by far over that period is Peru. That has the best risk-adjusted return. Now, what's the reason behind that? Well, if we drill down into the description of that fund on Stock Card, you can see that the largest exposure, the largest holdings for the fund, are in two companies. One of them's Credit Corp and the other one's Southern Copper. Now, Peru's a big copper exporter, and so if the price of copper goes up, that's going to be good for this stock. And because this stock is about a fifth of the actual index for the country, that also means that you'd expect this Peruvian index and the Peruvian tracker to go up in value. And here we're looking at the price of copper since 2018, and you can see that yes, it has had a strong rally recently. That's going to benefit copper mining companies, and it's going to benefit Peru. So I think that's the primary driver behind the rally that we've seen and the risk-adjusted momentum over our 143-day look-back period. Now, over that same 143-day period, I've plotted the three best country performances in terms of risk-adjusted return, but also the worst three. And you can see that Peru is well above the next two contenders, which was the United Arab Emirates, but also Qatar. Clearly, the price of oil has shot up recently because of what's going on in the invasion of Ukraine by Russia, but also as a result of increased economic activity following the pandemic subsiding. And down amongst the worst performers, you can see China is one of the worst of all. So the first entry into our portfolio, our first winner if you like, is Peru. The second group of funds we'll look at are the factor funds, and here we've got 18 funds to choose from. Here the backtest showed that there was a longer period that would be optimal for us to look back to calculate momentum. So here we're looking back almost 5 years in order to choose the best risk-adjusted return. And the fund that comes out on top is IWF. So that's a growth fund. It's not particularly tilted to small caps or large caps. It's got US large caps and mid caps. And that one over this time period is running roughly neck and neck with an S&P growth fund, which is IVW. So that would be large cap growth. And if we look at the actual returns over that 5-year period, you can see that for the best three and the worst three funds, all of them are pretty much falling since the beginning of 2022. But certainly during our look back period, IWF, this growth factor fund, comes out on top. So that's going to be our choice for our factor fund. Next, we'll look at US sectors, and here we have 11 funds to choose from. For sectors, the look-back period that was best was around 4 years or 846 trading days. And here the clear winner was technology, because over that period, it's largely those mega-cap tech stocks which have outperformed. The runner-up amongst sectors was healthcare, but you can see that's quite a long way behind tech. Again, we can look at the best three and the worst three of these sector funds, and you can see that many of the sectors suffered a turnaround at the beginning of the year as there was a pullback in risk appetite in markets generally. And energy, if we were to use a much shorter look back period, would be the fund that we'd choose, because that's been rallying strongly as the price of oil has surged. But given our look back period, which is quite long, XLK comes out on top. So technology is going to be the choice for our sector fund. We have 8 commodity funds to choose from. And with our 3-year look-back period, you can see that the winner is DBB, which is the PowerShares DB Base Metals Fund. Now, in this case, the agriculture fund is not far behind. There's been a big rally in the price of wheat and corn, say, again, largely because of this crisis as Russia invades Ukraine. Both of them are large producers of agricultural commodities, so a reduction in supply is going to cause a squeeze in that market and push up prices. So I suspect in future, if that supply shock remains in place, then there may be a turnaround between these two funds. But certainly for now, DBB comes out on top, and base metals, industrial metals, is our choice for our commodity fund. Now, I said there were 8 funds to choose from. Where's the 8th one? Well, it's actually a carbon fund. But given our look back period, we don't have complete data for that fund yet because it was launched quite recently. But as that data becomes available, you'll start to see that appear as well as one of the funds. Now, I included Joe amongst our commodity funds, but you can see that it's also a very volatile fund. So that would have been scored down because of its volatility. And that's why DBB wins, even though its momentum is actually lower than that of Joe. And our final selection will be our bond fund. And here we have 9 funds to choose from. The look back period here is 4 years. And over that period, you can see that convertible bonds come out on top. Now, I was in two minds as to whether I should include convertible bonds with the other bond funds, because it's not really a bond fund. When equity markets have been rallying very hard, then it will track the equity market quite closely, because that's one of the behaviors of convertibles. They become more equity-like when they rally. But still, for now, it's included in our bond universe, and it's certainly the choice for this month. Now, not far behind it are tips. And the reason why they've done very well, of course, is because of very high US inflation. So again, this might be one example where we see a turnaround in the months ahead. Now, the reason why CWB, the convertible bond fund, has been chosen was largely because of this huge rally in 2020, as every risk asset was kind of buoyed upward by euphoria. Since even before the end of 2021, you can see that that's been trending downwards quite hard. Now, it's also a very volatile fund, so that would tend to score it downwards when we look at risk-adjusted return. So again, I think this will probably be subject to a switch next month, but we'll just have to wait and see. The three worst performing funds over this period have been high yield credit, so that's HYG, but also emerging market bonds have certainly plummeted. Now, part of that is a pullback in risk appetite. Emerging market assets tend to fall when people are more cautious, but also part of that is the spillover from a potential default in Russian sovereign bonds. They don't make up much of those indices, but they certainly make up fear in that asset class. So you can see why those have particularly suffered over the recent months. We'll be publishing updates to this portfolio, and you'll be notified of them if you've got a VIP account on stockcard.io. Now, if you use PensionCraft as the promo code, you'll get a 10% discount when you sign up for VIP access. You can also try out the app. It's free if you do that. It's got lots of stock screens. It's very easy to use. And I think it's a good way to learn about how to choose single stocks. But it also has ETFs. And that's the functionality we'll be using when we create our portfolio in StockCard. So the promo code is PensionCraft, no spaces, and that'll give you a 10% discount. So this is what the stockcard.io website looks like. You can research single stocks. Here you can see in the top right. You can research exchange traded funds, or you can enter your own portfolios, or look at portfolios that other people have created and follow them. So if you wanted to follow my portfolio, you could type in Ramin's Global Winners, and here it is, and I can click on that. And that'll give you the contents of that portfolio. So here are the 5 funds that we've chosen. So we've got that Peru fund, we've got iShares Russell Growth, IWF, we've got the Technology Select Fund, XLK, Base Metals, DBB, and that Convertible Bond Fund, CWB. So there we have it. That's our initial portfolio, and we'll be tracking that through time. And I think it will be useful for keeping track of what's going on in markets, but also to learn about the drivers behind that momentum. Don't forget our offer. Our promo code is PensionCraft, no spaces, and you can go to stockcard.io to sign up for VIP membership to be informed of any changes in our portfolio. And as always, thank you for listening.